and you're all very welcome to GoldCore's webinar, Has Gold's Bubble Burst, or is this another buying opportunity? I'd like to extend a warm welcome to everyone that has taken the time to register and attend today, especially some early risers on the west coast of the US and indeed further afield. Thanks again for taking the time to listen in. A very brief introduction to GoldCore, the host for today's webinar. Founded in 2003 as a precious metal specialist, GoldCore is devoted to the provision of honest, objective, jargon-free advice in our arenas of excellence. As a recognized global expert, we enable people to trade and store precious metals with unparalleled safety and convenience. It is our intention that today's webinar will provide you with informative and practical insight into the precious metals market. Please visit goldcore.com for more detailed information. The agenda for today's webinar is to present a review of the performance of precious metals in the first 6 months of 2013, to assess the market conditions for the remainder of 2013 and beyond. We will, of course, leave time for your questions and have allocated about 15 minutes to the questions and answers session. I'm going to do a quick introduction to your panel today. My name is Michael O'Brien. I'm the Marketing and Communications Manager here at GoldCore, and I'll be your moderator today. Mark O'Byrne is the panelist for today's webinar. Mark is the Head Research and Executive Director at GoldCore. Mark is recognized globally as a leading analyst on the precious metals market, and his daily market updates are quoted and reported on in Dow Jones Market Watch, Bloomberg, and many others. Mark will present an analysis of the performance of the precious metals market for the first 6 months of this year, and will present his research on why the price of gold and other precious metals has retrenched. Mark will also present his insights into the next 6 months and beyond, and will answer questions from the attendees in a Q&A session. I'm going to pass you over to Mark O'Byrne now. Okay, Mark. Hello, and you are all very welcome to GoldCore's webinar, Has Gold's Bubble Burst, or is this another buying opportunity? I'd like to extend a warm welcome to everyone that has taken the time to register and attend today, especially some early risers on the west coast of the US and indeed further afield. Thanks again for taking the time to listen in. A very brief introduction to GoldCore, your host for today's webinar. Founded in 2003 as a precious metal specialist, GoldCore is devoted to the provision of honest, objective, jargon-free advice in our arenas of excellence. As a recognized global expert, we enable people to trade and store precious metals with unparalleled safety and convenience. It is our intention that today's webinar will provide you with informative and practical insight into the precious metals market. Please visit goldcore.com for more detailed information. The agenda for today's webinar is to present a review of the performance of precious metals in the first 6 months of 2013, to assess the market conditions for the remainder of 2013 and beyond. We will, of course, leave time for your questions and have allocated about 15 minutes to the questions and answers sections at the end. I'm going to do a quick introduction to your panel today. My name is Michael O'Brien. I'm the Marketing and Communications Manager here at GoldCore, and I'll be your moderator today. Mark O'Byrne is the panelist for today's webinar. Mark is the Head of Research and Executive Director here at GoldCore. Mark is recognized globally as a leading analyst on the precious metals market, and his daily market updates are quoted and reported on in Dow Jones Market Watch, Bloomberg, and many others. Mark will present an analysis of the performance of the precious metals market for the first 6 months of this year, and will present his research on why the price of gold and other precious metals has retrenched. Mark will also present his insights into the next 6 months and beyond, and will answer questions from the attendees in a Q&A session. So please bear with me while I transfer you over to Mark.
Hello everyone, and thank you all for joining us on this webinar today. It's quite an important webinar because we are at an important juncture for the gold and silver markets. We are witnessing a degree of apathy amongst the mainstream public and a degree of concern and indeed some cases fear amongst some of our clients, and indeed you see it in the wider gold and silver bullion communities. So we are now 2 quarters into the year, and it's an important time to pause, to take stock, and to review the performance of the precious metals. So what has happened year to date, price-wise? Well, year to date, price-wise, gold is down 25%. Silver is down even more, it's down 36%. And platinum is down 11%, and palladium 2.3%. So yeah, bottom line is we've seen very, very sharp falls in the prices, particularly of gold and silver, less so of the platinum group metals. So I suppose it's important to step back and to look at the context and look at the long-term situation. So this is a chart showing the price of gold and its bull market since 1999. So in the bottom left-hand corner of the graph, you can see that gold was at $250 per ounce in late 1999, around the time that Gordon Brown sold the Bank of England's and the British People's Gold Reserves. And at that time, and in early 2000s, there was huge apathy amongst the public, and that has continued to this day. But things have changed somewhat, and in recent months, we were beginning to see some of the public going slightly from the mainstream, going slightly from the fringe into the mainstream, but it was still very much an asset class that was owned by the minority of people. So the context is that gold's gone from $299 in 1999 up to the top right-hand corner of the graph, $1,900 in August 2011. So gold had risen nearly 8 times in 12 years. It was up roughly 17 to 18% per annum. So this was something that was making even people who are bullish on gold in the long term, given the macroeconomic and indeed monetary fundamentals, pause for concern. And we warned at the time that gold was overvalued in the short term and that we could see a correction. We actually warned that we could see a correction on a par or on a scale of the correction that was seen in the 1970s when gold fell by 50%. So since then, gold has fallen by 40% from the 1900 nominal price high to 1200, just below 1200 recently, and today we're actually just above that level, around $1,240, $1,250 per ounce. So I suppose the question is this a correction, or is this the start of a bear market? Well, we believe that this is it's more of a correction, and it may even be a cyclical bear market within a secular bull market. And why we believe that is bull markets tend to last 15 to 20 years. And you see that clearly in the Nikkei, the Dow Jones, the Nasdaq, in many of the classic bull markets that we've seen in the 20th century. They tend to last 15 to 20 years. And then oftentimes you see, conversely, you see bear markets of 15 to 20 years. So another interesting and important fact is that, and it's one that Jim Rogers has pointed out, in the 20th century, commodity cycles tend to have 17 to 18 year bull markets or cycles of up and down. So if gold bottomed in 1999, which it did, and then if it was to match the typical 17 to 18 year bull cycle, then you would see gold peaking in around 2016 or 2017. And we continue to believe that that is likely. We think it's somewhere between 2015 and 2020, given the very strong fundamentals that we see today. But in the short term, obviously, absolutely anything is possible, and we've seen very sharp falls. As I said, we're down 25% year to date in gold. And this chart is important because I suppose it helps helps to basically informs as to where support may be. Resistance is at the 1,000. Sorry, resistance back in 2009, 2010 was at the 1,200 ounce level, and gold had grave difficulty getting through that level. And today, possibly that could become support. The next level of resistance was from 2008 to 2009. Gold had great difficulty getting through $1,000 per ounce, and therefore that could be the next level of support. So in the event that gold has a weekly close below $1,200 per ounce, you could, or even a daily close below $1,200 per ounce, we could see further sharp selling come into the marketplace, margin calls, stop losses being triggered in the futures market, and gold could fall quite sharply down to the $1,000 per ounce level. But we do believe that there is a floor beneath the marketplace, particularly given the huge industrial demand that we're seeing, the huge investment that we're seeing internationally, and the fact, and this important fact, that gold mining production, the average cost to produce 1 ounce of gold in the world today is $1,200 per ounce. So that will not support gold in the short term, but it will support gold in the medium to long term, because gold mines are actually putting certain projects, production projects, on hold. They're actually letting a lot of staff go, and there's a lot of retrenchment in the industry, which will actually affect production in the coming years. So I suppose, yeah, the bottom line, as Yogi Berra said, it's tough to make predictions, especially about the future. In terms of price, absolutely anything can happen, particularly in the short term. But it's important to realize that in the medium to long term, the prices will rise. And it's not that we have a crystal ball and we know the gold and silver price will rise. It's the fact that not the gold and silver rise, but rather that the dollar, the euro, and the pound, they lose value. Fiat currencies, by their very nature, lose value over time, and that's what inflation is. People think inflation is the price of things are going up. Inflation is well, it's actually two things. It's a loss of purchasing power. It's your purchasing power. The value of the money in your pocket is losing value over time, and so it's the more classical definition of inflation is an increase in the money supply, and we are seeing that globally, and we'll cover that later in this webinar. So in terms of where we are in the cycle, obviously we've seen sharp falls. We're down 40% from the peak, the nominal peak, and we have seen quite a degree of, I would say, panic on behalf of the speculators. There's been huge liquidations in the futures market and in the ETF marketplace, and I would think that we may even have seen capitulation, and we are seeing despondency. So I think the bottom line is difficult to say, but I think we're at the bottom end of this cycle of market emotions. This is a chart that we've looked at for a long time, and we think it's important to always be aware of this from a contrarian perspective. When markets become overbought and are becoming a little bit irrationally exuberant, shall we say, they get into this thrill and euphoria phase, and there was a small degree of that in June, July, August 2011. Not a huge amount, particularly not a huge amount amongst physical investors. As physical investors were not buying gold in order to make a capital appreciation or to get rich, or they weren't buying gold out of greed. Many were buying gold because they were genuinely concerned about the situation. But there was, from a speculative point of view, there was some thrill and euphoria, I suppose, and that's what led to the spike up in August 2011. Today, as I said, I think we're down at this end, so from a contrarian point of view, I think there is value to be had. Dollar cost averaging into position. We would caution you never catch a falling knife. The momentum at the moment is very much to the downside, as we saw in the previous chart. And therefore we think, yeah, it's very important not to put large lump sums into gold this time. We would think you'd be better off dollar cost averaging, euro, pound cost averaging, buy a little bit every week or every month, and use momentum to your advantage. So if we see a higher monthly close, a higher consecutive monthly closes, a higher quarterly close, that's the way to start buying and basically start accumulating physical over the medium to long term, and that way you'll get more competitive prices. As Rothschild said, the time to buy is when there's blood in the streets. There is a small amount of blood in the streets today, particularly amongst the speculators and people who are leveraged in the futures market, and also some people in ETF, and I suppose people who are not diversified and were speculating with gold rather than buying gold as in a physical format and putting it away for the long term, 5, 10, 20 years, and keep willing it for children and grandchildren. So I suppose this, the follow-on from that in terms of emotions and psychology is the importance of being aware of the wider investment psychology. So this is interesting. This is Business Week was one of the leading financial publications in the world in August in the 1970s, and in August 1979 they published this magazine report, basically the front page is the debt of equities, and they said that the stock market was a terrible place to invest, basically, and how inflation basically was destroying the stock market. At the time, this chart actually does not quite capture it. We should actually have this chart going back to 1979, which would show you the S&P, I believe, was around 30, and it rose to around it was I think about 100, it rose to around 300, and basically embarked on one of the greatest bull markets the world has ever seen, which culminated in the rise to over 1,400 in 1999. This was the time when the media conversely was telling everybody you should be day trading and you should be buying stocks. Now's a great time to buy stocks. In fact, it was the worst time to be buying stocks. So that's just, I suppose, a guide to, the wider backdrop and the wider sentiment. So what is the sentiment in the gold market today? Well, the sentiment in the gold market today is very, very negative. And it's extremely negative, as you can see. Business Insider is one of the leading financial publications in the world today, online publications. And these are just some of the headlines that we've seen on Business Insider in recent, basically the last two or three months. And yeah, everyone should be thrilled by the gold crash. I mean, it's a bit of a bizarre headline. I think some of our clients are thrilled because they can pick up gold at much cheaper prices. But I suppose the editor of Business Insider is suggesting that people should be thrilled by the gold crash because it suggests that the economy is picking up, and therefore it's a good time to buy equities and buy other investments. And I think we would fundamentally disagree with them because, unfortunately, we believe that the economy is far from recovering, quite the opposite, and there are huge risks there that are not appreciated. Many banks have declared the end of the gold era, the end of the bull market, and the death of gold in recent weeks. Most of the major banks have all declared the death of the gold bull market. And indeed, it's interesting that many of the same banks who are declaring the end of the gold bull market, they're actually opening up storage facilities to cater for their high net worth clients. Storage facilities in Zurich and also in Hong Kong and particularly in Singapore. So there is a degree of, I suppose, a dichotomy in what they're saying to the public in terms of their views on gold. But at the same time, they're commercially, they see opportunities in the gold market, and they're opening up a vault space to cater for high net worth clients, because they obviously believe that there is going to be demand from these high net worth clients for gold. So we would caution that you just need to ignore the noise, particularly coming from banks. They have been bearish on gold for years. Some became bullish on gold in recent months towards the top there. Ignore alarmist articles, ignore alarmist headlines. Always focus on the real world fundamentals, which we're going to look at in a second, and on the importance of diversification, and most importantly on the long term. Gold is not a short-term speculation, and obviously, yeah, we've become aware of that, particularly in recent months. So, what is the outlook for gold this year and in the coming years? Well, we think the debt situation, we have a global debt crisis today, and we think the debt situation globally is the fundamental driver of the gold market. And we find it quite bizarre that people say we're in recovery and that the gold bull market is over, and yet debt levels around the world, far from decreasing, they're actually increasing very, very significantly, still at a very, very steady pace. So obviously one example of this is in the US, where this 16.4, it's 16.4 trillion. Trillion is a big number, and people often forget how big a trillion is. A trillion has 12 zeros after it. So it's 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. It's a big, big number, and that debt has increased. It's gone parabolic in recent years. When Bush came to power, 6 trillion in 2000, 1999, 2000, just below 6 trillion. Bush left 2008. The price had gone to about just over 9 trillion. And then since Obama came to power in the last 5 years, it's increased at an even faster click, and it's now over 16.5 trillion. And this shows that there's no political will in Washington to deal with this situation. The deficits in the US are over 1 trillion per annum. They're going to be over 1 trillion in 2013, and in 2014 and projected to be similar in the coming years. Potentially they could go higher given the scale of the crisis, and also given the fact, a very important fact that is continually ignored, that there is 50 trillion to 100 trillion of unfunded liabilities in the United States of America. There is a degree of Enron accounting going on, and it would make auditors around the world blush the way that some of these off-balance sheet accounting that goes on. So this to us is one of the most, there's a few, but this is one of the most important charts and one of the most important drivers. And it's not just happening in the US. Money supply internationally is continuing to increase at a steady clip. Globally, it's now recently is over 55 trillion, and it's increased from below 15 trillion in 1998. So the bottom left-hand corner of the graph here, this is a global money supply, as the chart says. And we see this interesting dichotomy at the top here, whereby money supply, it's slowed down, but it's still increasing. It's a little bit flat in recent months, but since the start of the year, it has still increased, and yet the gold price has fallen precipitously. We think this is an anomaly, and we think that this is a short-term anomaly, and in time we think that this correlation that we've seen in recent years will continue. Because we think the bottom line is it's to do with supply and demand, and economics is a very simple thing, and the more supply you create of something, less it's going to be worth in the long term. Gold is very, very rare, very, very finite. All the gold in the world fit in the 21 meter cube in the centre court of Wimbledon, and supply increases at about 1.5% per annum, whereas money supplies globally are increasing at 5, 6, 7, 8, 9, and 10% plus per annum. So keep an eye on that. If this began to fall for a year or 2 years, maybe then you might be concerned about the bull market. The next chart is again focusing on the dollar. The dollar is obviously one of the fundamental drivers of the gold price, and the weaker dollar in recent years has contributed to higher gold prices. It is just one of the factors driving gold prices. On occasion, you can actually see the dollar increase in value and gold increase in value at the same time. And during those periods, gold obviously makes more gains in terms of euros and pounds and other fiat currencies. But we can see in recent months that the dollar trend has been higher and the gold trend has been lower, particularly in recent months since the start of this year. How sustainable that is, I don't know. The trade deficit numbers came out today and they're over 40 billion again. They were 12% higher than expected. And basically the bottom line is the US has massive deficits of over 40 billion every single month and continues to have them, and therefore they will need a lower dollar in order to address those trade deficits. So these fundamentals, and there are many other fundamentals, but obviously we have only a degree of time, so we've focused on two of the major ones today. But since 2003, because of the scale of debts in the Western world, we believe gold was entering a secular bull market and that it would surpass its inflation-adjusted high from 1980 of $2,400 per ounce. The nominal high was $850 per ounce. The inflation-adjusted high is $2,400 per ounce. Today, this price chart is actually out by a small degree. It's gold obviously fallen by more in the intervening period. But the bottom line is we believe that gold will surpass this $2,400 per ounce. That's what tends to happen in the vast majority of bull markets. They tend to surpass the inflation-adjusted high. Sometimes they surpass the inflation-adjusted high by multiples of the previous price. Mark Twain once said that history does not rhyme, but it often repeats. And we do think that it's important to learn the lessons from the 1970s bull market. This is an interesting chart that we put together late last week. And it basically looks at the gold price in the 1970s from 1971, when Nixon went off the gold standard in August 1971. Gold was at $35 per ounce. Up to the end of the bull market at $850 per ounce on January 21st, 1980. But it wasn't all plain sailing, it wasn't all happy days. There were periods of sharply falling prices, and basically that is seen clearly here. So gold rose from $35 to $200, or nearly 6 times in 4 years. And that culminated here in late 1975 in the green circle here. Gold then fell by nearly 50% from nearly $200 to nearly $100, and it bottomed in August 1976. From a seasonal perspective, gold does tend to bottom in the summer months of July and August, which is interesting as well. And what's interesting at this point here, there were opinion pieces and articles throughout the world, including the New York Times, announcing the death of the gold bull market, sneering at gold bugs, inverted commas, these crazy people who buy gold because they're concerned about inflation and how wrong they've been proved, because inflation is contained and the economy is recovering. That was the tone of the New York Times article. And that article was released in August 1976. Gold subsequently rose 8 times in the next 4 years. The economy went into a recession. There was huge stagflation, huge inflation, and an oil crisis. So that shows you the importance of not always going with the herd and I suppose the mainstream. It's important that you always think for yourself and I suppose have a contrarian perspective on these things. And that will be important when gold goes into the bubble phase as well, because sections of the media will probably be very bullish on gold. The vested interest will no doubt be bullish on gold, and it will be difficult for you to decide when to take profits and to reduce allocations to gold. We believe everybody should always have an allocation to gold, but there will be a time to reduce allocations, and therefore this having this contrarian perspective will be important when gold goes into the mania phase and goes parabolic, as it did in 1979, and as indeed it does in the course of all bull markets, whether it be the Nikkei, the Nasdaq, and the majority of bull markets throughout history. So that's what I was alluding to there in terms of knowing when to reduce allocations or sell. That's a question that we will do a full webinar on soon, because people do have concerns about that. But I suppose we would say that you just need to focus on the long term. We do think it's a 15 to 20 year cycle. We'd be very confident about that. And as I said, most asset classes have 15 to 20 year cycles, and most commodity markets have 17 to 18 year cycles. Bill Bonner alludes to this. The founder of Agora Publications and one of the most astute I suppose investment advisors or commentators in recent years, and his quotation there alludes to the importance of always having a long-term outlook. You know, short-term trading is a sure road to the doghouse, and it's not for the majority, the vast majority of people just can't do it. All the evidence shows it. So this chart here, well, so this is a final chart on the 1970s, and it shows where we are today vis-a-vis the 1970s. Gold did not go parabolic. There was a little bit of exuberance in around this area here, but we do believe in time that gold will replicate the 1970s. And at some stage up here, it will be the time to reduce allocations. But we do not believe that time is just yet. The time to do that will be, I suppose, when people in Western countries view gold as people in Asian countries view gold today, when they view gold as an important source of wealth, when there is a realization that gold is a form of financial insurance, when people are looking at gold as financial insurance, not purely as a speculation, that will be, I suppose, an indication possibly that gold is, the bull market is ending. When you see banks calling for gold at $10,000, $20,000, $30,000 per ounce, and Goldman Sachs makes a big, huge call like that, maybe you should get nervous and reduce allocations. When the man in the street knows both the price of gold per ounce and the value of gold. Today, most people in the world don't, or sorry, not most people in the world, Asians, most of the Asians do know the price of gold, but people in the Western world, if you did a vox pop in Washington, London, or indeed Tokyo, and you ask people what is the price of gold today, most people would look at you blankly and say, I don't know, and they'd laugh nervously. That will change, and when people start talking about gold at dinner parties, as they talked about property in recent years, then it will be time to reduce your allocations to gold. So what is the safest way to own gold and silver? Well, yeah, I think majority of people are realizing that it is physical gold. You need to reduce your counterparty risk. Paper gold has huge hidden risks, whether that be futures or indeed ETFs, which have huge levels of indemnification, and you are basically an unsecured creditor of a bank, and there's a lot of counterparty risk in the banking sector, and there's a lot of systemic risk. Digital gold is very popular, obviously, in the retail sector in recent years due to the extremely low costs, but we do think there are unappreciated risks in digital gold, the likes of bullion vault, and we think it's important that people are aware of them. The risks are that you have one counterparty and their technological platform that you can deal with. So you can only sell your digital gold back to that one digital gold provider, that one online platform that sold it to you. So this is basically a form of closed loop buying and selling. It's a closed loop market, so there is no competition in that market. You have a dependency and an over-reliance on one single entity and one counterparty and their technologies, their server, their website, and indeed on the internet itself. And you also have the risk from your perspective of your access to a computer and to the internet, and if you do not have that access, then you have difficulty in liquidating your position. Whereas if you own physical coins and bars, either in your possession or allocated accounts, it's an internationally competitive market, so you can buy and sell your bullion back to a whole range of different bullion dealers in different countries. So you don't have that dependency on any one provider. If you have 50 kilograms or 20 kilogram bars, you can call us up and say, I want to sell, and you can basically price it. If we say to you, sir, we can't make a market for whatever reason, which is highly unlikely, but if we did, you could sell it to any one of the numbered bullion dealers in the world. And that competition is absolutely vital, because it means that you have access to your bullion. You take delivery of your bullion with a phone call, with a fax, or indeed with an email. You have maximum liquidity, and you have competitive pricing at all times. So we think that's an unappreciated risk that we think people should be aware of. Paper gold, Kyle Bass, the man who took delivery of $1 billion of gold for the Texas Teachers Retirement Fund, highly respected. Great quotation from him. Not going to read it. I hope you've read it already, and because I think a commodity default is something we've warned of for a while, and may be on the horizon, given the huge fall we're seeing in the inventories as we speak.
Mark, thank you very much for an engaging and informative presentation. And as we said at the top of the meeting, we're going to give some time to questions. And if I may, Mark, I'm going to put a series of questions to you so you can take your time in replying to them, because we have a good 15 minutes. The first one is from Bruno. Bruno asks, could you talk of the relation between interest rate increases and the price of gold?
I can indeed, yeah. It's a good question, Bruno, and it's an important question, and there's a lot of misunderstandings about it. A lot of the commentary I see suggests that once interest rates begin to rise, gold prices will fall. That is simplistic in the extreme. The fact is that rising interest rates are actually bullish for gold. This was clearly seen in the 1970s, and particularly in the late 1970s. We showed this in the last webinar, in a graph in the last webinar, and we'll cover it again in coming webinars, and indeed in our market update. But basically, interest rates rose very sharply in the late 1970s, as did the gold price. Where gold becomes vulnerable is towards the end of an interest rate tightening cycle. So when when interest rates have increased for a period of time, when interest rates are well above the rate of inflation, and you have a positive real rate of return, you have positive real interest rates, then gold becomes vulnerable. And I think it probably is the key indicator. We've covered it before, so we didn't cover it today, but probably the key indicator is negative real interest rates. We are borderline negative real interest rates today. In some countries, we are in actual negative real interest rates. So when you get positive real interest rates, so interest rates above the rate of inflation, then you would have to be concerned about the bull market. But today the world is so saturated in debt that the Federal Reserve cannot stop quantitative, can barely stop quantitative easing, can barely reduce quantitative easing, let alone increase interest rates, let alone increase interest rates to 3, 5, 6, 7%. The long-term average in the 20th century, average interest rates around 6%. There's no way they can get near that. If they did that, they would collapse the entire economy, and we would have a deflationary depression on the par of the 1930s. So, but it's a good question, and it's something to watch out for. In later in this decade, that may, if they gradually increase interest rates, that may become a risk, and it's important to keep an eye on it.
Okay, next question, Mark. It's from Tommy. There was a lot of talking up of silver during 2012 and early 2013. What does the current price position tell us about trying to predict precious metals prices into the future?
Yeah, well, I suppose there were people, including ourselves, who were bullish in the short term, and we're rarely bullish in the short term. We tend to say, listen, in the short term anything can happen, and we do focus on the medium to long term and the fact that currencies are debased over the long term, and that's why you have to have an allocation to precious metals and own physical bullion. So talking up, it may well be, I mean, we did believe, we said that we thought it was likely that silver would perform well in 2013. It hasn't, and we have to put our hands up and say, mea culpa, The factors for that, there's various factors. A big part of it is that there has been selling by players on Wall Street, concentrated selling, and I suppose a degree of, well, either they're selling for profit in the futures market and manipulating the price lower for profit, or they're manipulating the price lower for other purposes. But the concentrated selling was seen in less liquid markets in Asia, in electronic markets, in the comics. I mean, we saw just incredible price moves of 200 tons of gold in 2 or 3 tons, or sorry, 2 or 3 trades, should I say. 200 tons of gold is 15% of annual production. So in that sort of scenario, it's even more difficult to you cannot predict the future price of any asset. But there are, I suppose, there is trends, and you need to focus on these trends in the long term. But in the short term, given the nature of the casino nature of the global financial system, it's nearly impossible to predict anything in the short term. So, Tommy, Yeah, good question. Nobody should be talking about anything particularly, well, they should never talk about anything even in the long term, but gold remains an important diversification that will, and silver will protect, are important diversification that will protect people and families and businesses in the long term.
Okay, Mark. Question number 3 is from Barry. And Barry's question is, the dilemma is, when gold reaches a new high range and we decide to sell, what do we do with the fiat that we receive? We know fiat will go to zero. Do we buy farmland, whiskey, or diamonds?
Yeah, well, fiat will go to zero. I suppose the question is when rather than if, and hopefully it's not in our lifetime. But there are many people who think that it could happen in the coming months and years. We think it's a possibility, and we think it's absolutely obnoxious and ignorant to laugh and sneer at people who suggest that there could be some form of a collapse. We think there is a possibility given the risk out there, but we think that more likely is a serious problem with the global economy, a shutdown, bank holidays, a shutdown of systems for a period of weeks or months while the systems reset. We don't believe that we're going to see the collapse of civilization as we know it or the collapse of capitalism as we know it. We believe there will be serious problems, way more serious problems that are being acknowledged, but we are not, I suppose we're not Armageddonists. But in a worst case scenario, if it did happen, yeah, it's a good question. There was this wonderful seminar with Jim Sinclair, a legendary investor in the hotel. Yeah, there was it doesn't matter what hotel. Hotel in London. Couldn't remember the name of it. The hotel in London there about a month ago, and there was about 500 people at the event. And Jim Sinclair stood up and he asked questions about the gold and silver market for about 4 hours. It was a phenomenal tour de force from a 79-year-old man. And he basically made the point that gold is financial insurance and gold is money, and people need to use gold in these basically when they need it to pay for things. So he said you need to have cash and gold for a period of 3 to 6 months to pay for food and energy and water, pay your bills, pay your staff, and just have that cash and gold there for a potential worst case scenario of ATMs not working, not being able to money out of banks, stuff that's been seen in Cyprus in recent weeks, incidentally. And then in terms of if you do have a hyperinflation and fiat going to zero, again, it's a worst case scenario. But if it did happen, yeah, obviously farmland. Maybe you want to buy farmland before that, but buying farmland, whiskey, probably I think water, more so I think water will be a very important thing to own, and having fresh water sources near your land. Diamonds are a funny thing because they're very difficult to value and yeah, it's a very subjective marketplace and you can get ripped off very, very easily. So I think, yeah, farmland, residential property, obviously property is you need to obviously need quality residential property in good areas, and obviously be sure that you can get a rental income. So you want to be near where there is production, where there is manufacturing, because life will go on, and that's the nature of capitalism. We are resilient and we will adapt, and there will be opportunities, but you just need to be very selective. So yeah, I hope that answers your question, Barry.
Thanks very much, Mark. Actually, I was with you in London. Actually, it was at Hilton Hotel, if I remember correctly.
Hilton Hotel, that's
indeed,
it, yeah.
Indeed. And I must say it was a superb presentation by Mr. Sinclair. Question number 4. It's actually, I've put 2 questions into one, Mark, because they're correlated. And the first part is from Maria, and the second part is from Anne. But what is the status of Perth Mint certificates, and whether unallocated gold is paper money?
Well, the permanent certificates, the status is that they are, basically it's the government of Western Australia, which is treble A rated. They're there since 1899. They're a government mint, and they're also one of the largest refineries in the world. So they, yeah, we believe that storing gold with the permanent is one of the safest ways in the world to own gold. Some people have concerns about sovereigns and about governments, and if you do, then you should store your gold with a private entity. And we also offer storage with Viamat in Zurich and in Hong Kong. So it depends on your preference. Some people tend to trust governments more because they believe governments won't go bankrupt, and don't trust private operators as much, whereas other people tend to trust private operators, and Viamat is one of the safest depositories in the world, basically that it brings out of Switzerland. With regard to unallocated gold, No, unallocated gold is not paper money. You own gold, but you are an unsecured creditor, basically. So there is more risk in owning unallocated gold. We tell people to be very cautious of unallocated gold. All unallocated gold schemes, except for the Permanent West Australia, because for the reasons that I outlined before, they're AAA rated. Their rents is $18.99. They're in rude financial health. They're a huge refinery. But if you are concerned about counterparty risk and you want to own gold in a safer way, then you should, and you sleep better, then you should move from unallocated to allocated, and you play the cost, and you decide that you want to own it in whatever format you want to own your gold, 1 ounce, 10 ounce, 100 ounce, 400 ounce bars, whatever you want. So if you are very concerned about counterparty risk, then yeah, exactly, move to unallocated to allocated. But I suppose, yeah, I hope that answers your question. The bottom line is I actually think there's more risk in digital gold, as I alluded to before, that nobody ever talks about. And it's not a question of bashing our competitors, so we have a high respect for both Gold Money and Bullion Vault, but we do think that they are more for people who we don't see them particularly as a store of wealth or as financial insurance. We see them more as ways to have exposure to the gold price up and down, and I think there's a room for them in a portfolio, but they should not be confused with financial insurance or as a store of wealth.
Mark, thank you very much. That's all we have time for today. Thank you for attending the webinar, and I hope it was a useful and informative session. It was recorded, and I'll send you a link to the recording. Just for your information, GoldCore, we're represented on a number of social media sites. We're on Facebook, we're on LinkedIn, we've approximately 9,000 followers on Twitter, so we'd very much like if you'd reach out and connect with us via these channels. And finally, if you have any questions, then please do not hesitate to reach out and contact us. Thank you very much, and goodbye.